You know, when you look at a massive city skyline at night, your eyes are just immediately drawn to those giant, glowing neon logos, right? Up at the very top of the skyscrapers.
Oh, absolutely. I mean, the branding is just, it cuts right through the dark.
Yeah, it's designed to be the only thing you focus on. You see a massive glowing apple or, those big illuminated blue letters, and you instantly feel like you understand the city just by looking at who bought the airspace.
Right, but what you are completely ignoring in that moment is the concrete.
Exactly. You are entirely blind to the thousands of miles of rebar, the subterranean water pumps, and that massive underground electrical grid that is actively keeping those neon lights from going dark.
Which is really the only reason those logos can even shine in the first place.
Right. So today on the Deep Dives, we are taking you away from the glowing neon signs. We're going straight down into the underground grid of the technology world.
It's a fun place to be, honestly.
It really is. So we have our hands on this short, highly concentrated piece of investor commentary that looks at the semiconductor space. And it specifically compares four major stock tickers, right? NVIDIA, Intel, Coherent, and Marvell.
Yeah, and it's a really brief note, but it captures this profound reality about how financial markets actually operate. It highlights the massive disconnect between what the public thinks is running the world and the companies that are actually keeping the lights on.
And whether you're actively managing a portfolio or, you just want to understand the physical reality behind the smartphone in your pocket, this text reveals a hidden truth about how we perceive success.
It really does. It completely flips the script.
Yeah. We're going to explore why the companies that hold the modern world together are rarely the ones whose names we actually know, and how recognizing these invisible giants gives you a massive structural advantage in how you view the market.
So to start, the author sets up the premise by drawing this really hard line between two types of companies in the tech sector. On one side, you have the universally understood giants, and on the other, you have total, utter opacity.
Okay, let's unpack this because the note points out that if you walk up to a casual investor and ask what NVIDIA does, the knee-jerk answer is GPUs, graphics processing units.
Instantly, everyone knows it.
Right. And if you ask about Intel, the answer is foundry. And that really got me thinking about corporate identity and how much it just mirrors high school dynamics.
Oh, that's a great way to put it.
Right. NVIDIA is the star quarterback right now. Intel is the class president. Everyone in the building knows their title. But I have to ask, is having a neat one-word public identity like GPUs actually a prerequisite for market dominance? Or is that just a byproduct of building consumer-facing products?
What's fascinating here is that it is entirely a byproduct of human psychology, and that bleeds directly into market psychology.
How so?
Well, human beings crave cognitive ease,
Yeah.
right? We desperately want to categorize complex systems into manageable little boxes.
Sure, we want it to be simple.
Exactly. Think about what a GPU actually does. It relies on parallel processing to handle thousands of mathematical calculations simultaneously. That's why it's perfect for, rendering video game graphics or training massive AI models.
Which is incredibly complex computer science.
Highly complex. But when an investor can reduce that massive multi-billion-dollar operation into a single word GPUs, it just feels safe.
It creates this illusion of mastery. You feel like you have your arms around the business model. Like, oh, they make the chips for the AI. Done.
Precisely. The brain doesn't have to burn calories trying to understand the physics of silicon wafers. And in finance, when a company's function is that easily digestible, it acts like a magnet for retail capital.
It draws everyone in.
Yeah, casual investors swarm toward the light they can easily see. They don't need a PhD in electrical engineering to know that NVIDIA is powering the AI boom.
Right. But the danger of that cognitive ease is that it creates a massive blind spot, doesn't it?
It absolutely does. We start to falsely equate public visibility with structural importance.
Here's where it gets really interesting because that brings us directly to the core mystery of the source text. What happens when a company simply refuses to fit into that neat one-word elevator pitch?
Right, the ones that don't have that simple label.
Exactly. The author explicitly brings up the other two tickers, Marvell and Coherent. And the text notes regarding the general public's understanding of them, quote, Marvell, no clue. Coherent, no clue.
Nobody knows.
Right. The author points out that nobody on the street could tell you what these companies actually manufacture. Yet in the very next sentence, the author defines Coherent and Marvell as the they do everything longs.
Let's clarify that financial terminology real quick, just so we're all on the same page.
Mhm.
When the author calls them longs, they're referring to a long position in investing.
Right, mean you're betting on them to go up.
Exactly. It means buying an asset with the fundamental expectation that its value will grow over time, as opposed to, shorting a stock where you're betting on it to fail.
Got it. So the author is extremely bullish on these companies, calling them they do everything longs. But I have to push back on the inherent contradiction there.
Okay, let's hear it.
If a consumer brand does everything, say a tech company makes phones, cars, groceries, and streaming movies, they become infinitely more visible, right? They completely dominate the cultural conversation.
And sure, they're everywhere you look.
So how does doing everything in the semiconductor space turn a multi-billion-dollar corporation into a complete ghost? It feels like a paradox. Shouldn't doing everything make you more visible, not less?
If we connect this to the bigger picture, you really have to separate the application layer from the physical infrastructure layer.
Okay, break that down for me.
Well, in the consumer world, like you said, doing everything puts your logo on every item a person touches. But in the semiconductor supply chain, doing everything means you are operating so deep in the subterranean architecture that you never even brush up against a consumer.
You're just miles underground, metaphorically.
Exactly. Let's look at Coherent, for example. The author says they do everything, but what does that actually mean? Coherent dominates a field called optoelectronics.
Optoelectronics, which honestly sounds like science fiction. What is the actual mechanism happening there?
Think about a modern data center. Those massive warehouses filled with servers that are actually running the artificial intelligence we all use.
Right, the cloud.
Yeah, the cloud. When those servers are processing petabytes of data, they have to communicate with each other instantly.
Right.
But if you try to send that much data across standard copper wiring, the copper creates electrical resistance.
Meaning it slows down.
Worse, it literally gets too hot, or the signal just degrades before it even reaches the other side of the room. So the industry uses light.
Wait, really? Light?
Yeah. Coherent manufactures the microscopic lasers and optical transceivers that take digital data, convert it into a pulse of light, shoot it across the fiber optic cable, and translate it back into data on the other end.
Oh, wow. So they are literally making the physical light that the internet travels on. That's incredible.
Yes. If you remove Coherent's optoelectronics, the servers literally can't talk to each other without melting the copper or just bottlenecking the entire system. They are foundational.
Okay, so that's Coherent. What about Marvell? If Coherent is handling the light, what is Marvell's version of doing everything?
Marvell is the ultimate data traffic controller. Because, a data center isn't just one big computer. It's thousands of different components, storage drives, memory banks, processors, and they're built by dozens of different companies.
Oh, I see. So none of it naturally speaks the same language.
Exactly. Marvell manufactures the networking infrastructure and data processing units that allow all those disparate pieces to actually communicate.
So they're like the translators.
Yes. Imagine a massive United Nations summit where thousands of rival diplomats are all shouting at once in different languages. Marvell makes the digital translators and the headsets that ensure every single diplomat actually understands what the others are saying.
And if the translator walks out of the room...
The summit collapses.
Pam!
Total chaos.
I see. So their absolute ubiquity is exactly what makes them invisible. They don't make the server rack, and they don't make the software you interact with on your laptop.
Right, no logos.
They make the critical translations happening thousands of times a second in the dark.
And because of that, they are purely business to business. They don't need the public to understand their elevator pitch. They only need the lead engineers at the major cloud providers to know exactly who they are.
That makes so much sense. And the author of the note captures this dynamic perfectly with a very specific corporate comparison. They simply state they're the Deloitte of semis.
That is such a vivid analogy.
I find it fascinating because it perfectly illustrates the concept of entrenchment. I mean, everyone recognizes the name Deloitte. They are a massive global professional services firm.
Huge. Offices in every major city.
Exactly. But if you stop a random person on the street and ask them to explain the mechanism of what a Deloitte employee actually did at their desk today, you'd get blank stares.
You would get the exact same no-clue response the author mentioned earlier about Marvell.
Right, no clue.
Are they auditing financials? Are they doing cybersecurity risk assessment? Are they implementing custom HR software?
Nobody knows.
Well, the answer is yes, they do all of it. They do everything firm of the corporate consulting world.
But why is being the Deloitte of semis such a profound compliment in this investor note? Because it feels like the author is implying something much deeper than just, being a large company.
This raises an important question because the author is pointing directly at the concept of ecosystem lock-in and switching costs.
Okay, switching costs. How does that work?
Let's look at how a company like Deloitte operates in the real world. When a Fortune 500 corporation hires them, Deloitte doesn't just offer some advice and leave.
Right, they stick around.
They get deeply embedded. They integrate their own software into the client servers. They train the client staff on proprietary workflows. They handle the legal compliance architecture.
So they basically become part of the company's DNA.
Exactly. Within a few years, Deloitte is so deeply woven into the nervous system of that corporation that the financial and operational pain of ripping them out and replacing them with a competitor is almost unimaginable.
It's structural stickiness. Once you're in, the sheer friction required to remove you basically guarantees your long-term revenue.
You nailed it. Now, map that exact mechanism onto Coherent and Marvell.
Okay.
When a massive tech company is building a $5 billion data center, they don't just buy networking chips and lasers off a shelf at Best Buy and plug them in.
Right, it's not a home router.
No, there is a grueling 18 to 24-month validation cycle. The engineers have to rigorously test the Marvell networking chips to ensure they communicate flawlessly with the Coherent transceivers.
Which then have to talk perfectly to the NVIDIA GPUs.
Yes, so by the time the data center actually turns on, these companies aren't just vendors anymore. They are the validated ecosystem.
So if a cheaper competitor comes along a year later and says, hey, we can make that optical transceiver for 5% less.
The data center operator is going to laugh and say no, because switching out that one part would require tearing down the network and triggering another 18-month validation cycle.
Just to make sure the new part doesn't crash the multi-billion-dollar service.
Exactly. Marvell and Coherent are the Deloitte of semis, because once they are integrated into the architecture, they become utterly indispensable. You literally cannot put the system online without them.
That perfectly transitions us to the financial forecast at the end of the source text. Because if a company possesses that level of structural lock-in, but has zero public hype, how does the market actually value them over a 12-month horizon?
This is where expectations meet reality.
Right. So what does this all mean? The author states that Coherent and Marvell are, quote, really solid, profitable longs over the next year. And then they provide this very specific boundary. They say, probably not 200% gains, but 100% seem reasonable here.
The phrasing there is incredibly deliberate. And it highlights a massive divide in how different types of investors view the market today.
I was really struck by the word reasonable.
Yeah, it's understated.
Very. I mean, in what reality is a 50 to 100% return on an investment considered just a reasonable expectation? In traditional finance, doubling your money in 12 months is a staggering achievement.
It's a home run.
Yet the author almost sounds apologetic that it won't hit 200%. It just says a lot about the distortion of modern tech investing, right?
We are currently living through an era dominated by momentum trading and retail hype. You have millions of retail investors scouring social media forums looking for the next viral ticker symbol.
They want the meme stocks.
They want the 200 to 300% moonshot. They are hunting for the companies with the cleanest, flashiest elevator pitch.
Right, GPUs.
Exactly. But the problem with those massive 200% runs is that they are rarely driven entirely by fundamental earnings growth.
So what drives them then?
They're driven by valuation multiples expanding simply because of public sentiment.
Meaning the stock goes up simply because everyone agrees it should go up, rather than the company actually, doubling its underlying profits.
Precisely. It requires perfect execution by the company, paired with relentless, unwavering enthusiasm from the public.
And public sentiment is notoriously fickle.
Extremely. If the narrative shifts or a new competitor steals the spotlight, that enthusiasm just evaporates overnight. A stock held up by hype can turn a 200% gain into a devastating loss in a matter of weeks because the underlying structural stickiness just isn't there to catch it.
So the author of our note is intentionally rejecting that game. They are looking at the foundational architecture of the internet and saying, we don't need the public to cheer for us, we just need the data centers to keep routing traffic.
The author's math is rooted in fundamental reality. Because Marvell and Coherent are so deeply integrated, because of that Deloitte-level switching cost we discussed, their path to a 50 or 100% gain doesn't rely on a viral social media campaign.
It relies on utility.
Right. It relies on the simple, undeniable fact that global data consumption is increasing, and these companies manufacture the physical toll roads that the data must travel across.
Institutional investors must love that.
They do. They prefer a high probability 50% return driven by systemic lock-in over a low probability 200% return driven by a popularity contest.
That is a phenomenal way to frame it. It's the difference between trying to guess which individual app is going to be the most downloaded next year versus just owning the physical servers that all the apps are forced to rent space on.
One requires you to be a psychic.
Yeah, and the other just requires you to acknowledge the physics of the system.
And, that pragmatic approach extends far beyond just picking stocks. It's really a philosophy for how to evaluate the complex systems all around you.
It changes your whole perspective.
There's a deep, enduring advantage in prioritizing structural competence over public visibility. The companies, and frankly, the individuals who do the complex, unglamorous integration work behind the scenes, often generate far more sustainable value than the ones fighting to be the neon sign on the roof.
We have dug through a lot of subterranean layers today on this deep dive. We started at the very top of the skyline, looking at the psychological comfort of companies like NVIDIA and Intel.
Right, how our brains just love the simplicity of one-word identities like GPUs and foundries.
Exactly. And then we explored the paradox of the they-do-everything companies. We discovered that in complex supply chains, true ubiquity requires you to operate so deep in the physical infrastructure that you just disappear entirely.
We unpack the mechanics of that invisibility, too. The optoelectronics turning data into light, the networking chips acting as digital translators.
And we saw how that translates into the Deloitte level of ecosystem lock-in, where the friction of switching vendors creates this massive financial moat.
A moat built on necessity, not hype.
Right. Finally, we looked at how stripping away the volatile need for public hype leaves you with the pragmatic math of institutional investing. Massive gains are just the natural byproduct of being an indispensable gear in the machine.
As we close out this analysis, there's a broader implication here that I really want you to consider.
Let's hear it.
The text today clearly demonstrates that the most indispensable parts of a technological system are almost always the hardest to explain in a quick elevator pitch. The companies literally holding the internet together are the ones the general public cannot describe.
Right, no clue.
Exactly. So if that principle holds true for the data centers powering global communication, you have to wonder where else it applies. What other invisible giants are quietly running the other industries you interact with every single day?
That immediately makes me think about, like, the food supply chain or the power grid.
Exactly. Think about the agricultural tech routing water to commercial farms, or the logistics software orchestrating global shipping containers.
Or the deeply entrenched databases processing our national healthcare records.
Yes. Who are the Deloittes of global agriculture? Who are the they-do-everything-longs of the pharmaceutical supply chain?
That's fascinating.
We spend so much time analyzing the brands that face the consumer, but there are massive, incredibly profitable engines operating in the dark, just beneath the surface of everything we touch.
It fundamentally changes how you view the infrastructure of your daily life.
It really does.
The next time you are standing outside at night, looking up at a city skyline, you should absolutely admire the glowing neon logos at the top of the skyscraper.
They're impressive for a reason.
They are. But take a moment to look down at the sidewalk. Think about the miles of invisible concrete, the optoelectronics, the digital translators, and the sheer mechanical force humming just beneath your feet.
The real foundation.
Because whether you are navigating the stock market or just trying to understand the modern world, the real power is almost always hiding in the dark.